Okay, in this video, I'm going to refer to step number 1 of my previous video where I spoke about how to comment on ratios. And I said step number 1 is to identify the applicable ratio. So remember, if you identify the correct ratio, step number 2 becomes an easy mark, because normally the financial indicators are provided for you, so you just need to give the trend. So it is very critical that you know which ratios should be used in what scenarios. So if you're answering a question paper on interpretation, and you see that they use the word loan on your question, or they refer to the word risk, or they refer to the word gearing, or they refer to the word financing, or they refer to the word borrowing. If you see any of this in your question, let's say they say to you the directors decided to take an additional loan, or they're referring to the gearing, or they're referring to the risk, you must know the first financial indicator that you need to use is the debt equity ratio. Now, the debt equity ratio simply shows you how the business is funded. Now, is the business funded using borrowed money, or is the business funded using the money that is coming from the shareholders, which is your shareholders' equity or your share capital? Now, so what does it mean? It means that when you're looking at the debt equity ratio, when the debt equity ratio increases, it means the risk is also increasing, because it means the business is borrowing more. Now, why are we saying that? The risk comes from the fact that if you borrow, you need to pay back with interest. And when you borrow, if the business makes a profit, the lender expects you to pay back together with interest. If the business makes a loss, the lender still expects you to pay back together with interest. Now, that's problem number 1. Problem number 2 is the repo rate and the prime lending rate. The Reserve Bank is the one that determines the interest that's going to be paid. So if they increase their repo rate, it also means banks are going to increase their prime lending rate, meaning to say the more you borrow, the more interest you're going to pay, and you don't have control over that. So the more you borrow, so if the debt equity ratio increases, it means your risk is increasing, right? And if your debt equity ratio decreases, it also means your risk is also decreasing. Now, why? Because the more you borrow, the more interest you're going to pay. The less you borrow, the less interest you're going to pay. So if they ask you about the loan, what do? You look at your debt equity ratio, you say it increased from this to that. If it increases, you already know that your risk is increasing. If it decreases, you know that your risk is also decreasing. Now, the other critical part in your debt equity ratio in the risk is whether a business is highly geared or the business is lowly geared. Lowly geared, right? What are we talking about? When you say a business is highly geared, we're saying the majority of the assets that the business has are bought using borrowed capital. If a business is lowly geared, we're saying the majority of the assets that the business has are bought using own capital. So the more the borrowed capital you use, the highly geared you become, and the higher the risk. If you use less borrowed capital, the less the risk, and it also means the business is lowly geared. Now, that's indicator number 1. Indicator number 2 is going to be your return on total capital employed. Sometimes they say return on capital employed. Sometimes they say return on average capital employed. It's still the same thing. It's capital employed. When you're saying capital employed, you're referring to what has been contributed by the owner, which is the equity, and what has been raised through borrowing, which is the debt. So what does the return on total capital employed do? It shows you whether the gearing is going to be positive or negative. So if your return on total capital employed is more than interest on loan, we say the gearing is what? The gearing is positive. But if your return on total capital employed is less than interest on loan, we say the gearing is negative. That's what it means. So you use the 2 indicators when you're dealing with, when they say loan, when they say risk, when they say gearing, when they say financing, or when they say borrowing. Then you use the debt equity ratio or you use the return on total capital employed. Now, so what that means is that with the debt equity ratio, you are mainly looking at the risk and whether the business is lowly or highly geared. With the return on total capital employed, you are looking at whether the gearing is positive or is negative.